All right, Derek, we are back, and there's a lot of things I want to get into today. But before we do, I want to talk about, some people say that they listen to the podcast and they appreciate any sort of tips, or whether we're talking about an ETF we're looking at or an individual stock. And I was talking yesterday to you briefly about a trick that you can do with an RMD, a required minimum distribution from your IRA. Do you remember that?
Yes, but I don't know if I'd be able to explain it, so I'm going to let you take that one.
So there's an old saying that goes, there are two tax codes in the United States, one for the informed and one for the uninformed. And this one seems to be one that is definitely not going to work for everybody, but it's interesting in the fact that there are people out there who are self-employed. And as a self-employed individual, or if you have ever been a self-employed individual, typically, what you'll have to do is, because you're not getting your income in the form of a W-2, typically what you're going to have to do is set aside quarterly estimates and send those quarterly estimates into the federal government and also the state in which you're at, assuming that your state has an income tax. So the problem, if you don't do that, is that at the end of the year, the federal government, the IRS, will penalize you for not having your payments in on time. And the problem with that is, even if you have a goal of setting aside, if your CPA tells you, hey, Nate, or hey, Derek, you're going to have to set aside $20,000 for the 2023 tax year, and every quarter I want you to send $5,000 into the IRS. What happens at the end of the year is, if you've made more money than we anticipated, you still could face a penalty. So one of the ways that you can get around that, and this would be for people who are over the age of 59 and a half, is that you are able to take your required minimum distribution that you would have from your IRA. Obviously, your required minimum distribution doesn't come until age 73 now, assuming that you have not already met that RMD age. But you could take a distribution from your IRA, and one of the things that you can do is send the entire amount to the IRS, to the federal government. You could split it up, send some to the state, some to the federal government. Why would you want to do that, Derek? Well, let's say that the first quarter came, my CPA said, Nate, you got to set aside $20,000 a year, and I want you to send $5,000 in per quarter. The first quarter comes, I don't send an estimate in. Second quarter comes, I don't send an estimate in. The third quarter comes, same thing. But I owe the federal government $20,000 at the end of the year. One of the things I can do is I can take a withdrawal from my IRA, and if I'm at the age where I have to take an RMD, that this would be easy for you, and I would send that $20,000 directly to the federal government. The benefit of that, Derek, is there's a weird rule with that, in the sense that when the government would receive that distribution from your IRA, traditional IRA, they deem it received in a prorated amount throughout the year. So it's not late. Even though I waited until December to give it to them, they realize that as if I've been paying that all year long. The other thing is I didn't give the federal government a tax-free loan, because that's essentially what we're doing when we're sending in our quarterly estimates, aren't we?
Sure, right.
On first quarter, second quarter, I'm giving it to the government. Technically, I don't have to have it to them by April, whatever the tax deadline is. So I'm not giving them that tax-free loan for the entire year. I'm keeping it in my investment account. I'm allowed to gain interest. I'm allowed to have capital gains. I'm allowed to have growth. I'm allowed to have dividends in this account that I would retain. And at the very end, at the latest moment, I would send that RMD to the IRS and be deemed on time with my payment. That's a pretty amazing thing. Of course, I think there's probably a select group of people that would apply to, but still a trick that's probably worth knowing.
Yeah, for sure. I was just thinking, sometimes, if you're a self-employed person, you have a business, your highest ROI investment is going to be reinvesting in the business. So some of those people wouldn't be contributing to an IRA for 40 years like a W-2 employee would. So that you would have to find somebody with the overlap. But that is a pretty cool loophole there. Because, the benefits of that, we don't have to go through the benefits of that. That's just like what you said, where you're not basically giving the government a free loan, and you can basically keep that money for yourself throughout the year. That's pretty powerful.
Yeah. Yeah, typically where it benefits somebody is if they have done well for themselves, they have an IRA, they're going to have to take distributions from that IRA, but they're not counting on those distributions to meet their standard of living. Mm-hmm. And so a lot of times, to your point, Derek, that is somebody who might be a business owner who's taking income from the business or getting a payment from that business in some form or fashion, or somebody who just is in great health and they enjoy what they do, so they're continuing to work.
Yeah, sure.
So, Derek, what do you have for me that you want to talk about? I have a couple things. I want to talk about the federal funds rate, some of the comments that Jerome Powell made, some of the comments that Senator Warren made, and just general commentary on those.
Okay, yeah, we could start with those. Mine's. I don't know how long we were going to spend on mine. I just had a couple questions for you about your real estate investment that you made with the purchasing of our building last year.
Let's go into that first. I mean, we can hit the federal. So I know that investing in real estate, I think, is probably something that interests you. I know that you had said that you had wanted to get into it, and that's something that at some point in your life you want to add into your portfolio,
For sure.
Aside from maybe REITs that you own.
But my first question is, do you think it was worth it? Because I know that basically as soon as you bought the building, we had like all these issues with the plumbing, and it's like it is a cash flowing property. Do you mind if I get into some of the?
Not at all.
Okay, good. So I know it is cash flowing as far as the tenants are paying higher than what your monthly expenditures, but then you get these big unexpected expenditures, like you have to replace pipes in the basement. So, and the biggest benefit that we thought was going to happen when you bought the building was we basically be staying in a physical location for as long. Like we would make that decision if we wanted to leave. We wouldn't be beholden to somebody else, whether they're raising rents or kicking us out or whatever reason. We kind of have control of our destiny in that sense. So just broadly speaking, do you think that the investment was worth it? And if you had to go back and do it again, would you just still do it? Knowing all the headaches.
Yes. So there definitely have been headaches. And I think anytime you own real estate, you're going to have headaches, especially if you've got tenants and you've got an older building. So number one, you're exactly right. I bought that building because I wanted to make sure that Crosby Advisory had a place to call home for the next 25, 30 years, 50 years, depending on how long Crosby Advisory does its thing there in Ashland, Ohio. Hopefully it's something that would be cool if it's something that passes on for generations to different owners, and we can continue what you and I are building right now. But so yes, purely based on that, it's worth it to me because our bread and butter is Crosby Advisory. That's how we make our living. We need an office to call home. That office is unique. It's got so much character to it. For those who don't know, the filming of Shawshank Redemption was done, at least a couple scenes were done there. The scene where Andy enters the bank and he withdraws the warden's money, that actually took place in our office. Yep, spoilers. I'm sure a lot of people have seen that by now. But so yes, that took place in our building. We get a lot of attention from that. People come in to see the vault, and buildings just aren't built like that anymore. I mean, with the marble floors, and it's a fortress.
Yeah, definitely.
Now, so is it worth it? Just based on that, I think it is worth it. I was prepared when I bought that building to, if we never got a tenant in that and we had to come up with just extra payment, it would still be worth it to me. What is unique about that building that makes it different than other buildings in Ashland is it has a second floor which has 16 or 18, I can't remember, I probably should know this, 16 or 18 individual offices that can be rent out. So somebody who has, what we find is, you might have a realtor or you might have an attorney or something that they just need an office. They need an office because in case they need to meet with people, or they need an office because they want to have a local phone number. And so they rent it, and we can rent them to them for $200, $300 a month, something relatively cheap. And that allows them to have their office. And of course, we have tenants in the building which help us with the mortgage. So the building does cash flow. most months. When I say most months, that building was built in the late 1800s, and this particular year, we've had a ton of trouble with leaking pipes. It's got a boiler. The boiler, of course, makes steam. The contents of that pipe, the water's under pressure, so you get bursting of pipes because the pipes are so old. So I am constantly, several times a week walking that building, looking at pipes and typically finding a leak somewhere, having to call a plumber to repair that. And that's been costly. And we've had the state of Ohio, because there's a boiler in, the state of Ohio inspects that boiler twice a year. It costs me money to have them inspect it, which is
of course
funny. And then they make recommendations. Sometimes they feel like they need to justify their bill that they're charging me. So they say, hey, you need to replace that. And then I'll have a licensed professional come out and they'll look at that and say, there's nothing wrong with this, but if that's what they're requesting, then that's what we'll do. So we get another bill upon that. And then you'll have times where, like this particular month, we've had the plumbers and HVAC people out there several times, and then the property taxes are due. And so you'll have months where you are, like we had this month, where we've got more going out than coming in. But I think what anybody who has been in real estate will find is if unless you're flipping a house, Derek, it is truly a long-term investment. In a perfect world, most months, my tenants would pay the mortgage for us. And over time, I would get appreciation from the building. I just got my K1 from the building. So I'm showing a loss on the building because we're able to depreciate the building. That helps me with my taxes. Mm-hmm. So there is some benefit to owning it, but I would not say, I think when you get on Instagram or if you get on these social media sites and you've got people that are pushing these real estate schemes, they make it sound like it's turnkey, passive income. They make it sound like it's all roses, right? Mm-hmm. And it's not all roses. There are headaches. But that's the part of owning physical real estate with any investment, whether I'm talking about stocks or bonds or gold. There's a good and a bad that comes with that, right? If I look at gold, you could say, look, it has kept pace with inflation, relatively speaking, over the years. Yeah, but it doesn't pay me any income, and I got to store it.
It's volatile.
Yes, there's volatile. There's any investment. There is some positives and negatives. I think the way I look at it is this helps round out my investment portfolio because I'm heavy in stocks. I've got fixed income products. I've got precious metal. I own physical gold. I own a home. I have a business. This physical real estate kind of helps me round that out so that I'm further diversified. It does help me out on the taxes, assuming I am able to show a loss on that property. So that's a long way of saying, Derek, I would do it again, but it's not something that you do and you're super successful the next month.
Yeah, I think that was like the broader point that I wanted to talk about was the Instagram geniuses that are talking about real estate as passive income. Like those people kind of drive me crazy. There's a lot of really good resources and accounts that you can follow that actually give you legitimate advice or legitimate insight on real estate. But the people that are like the Airbnb people where they're like, take out equity in your home, put a down payment on this Airbnb property, and it's 100% passive income. You can leverage that up 20-1, and you'll be an overnight millionaire. You'll be a millionaire in 2 years or whatever. Like those, I mean, it's delusional to think that there's an investment vehicle out there. And I'm not saying people haven't done that either, but like to say that that's a replicable solution, like that there would be a decent, if not substantial, amount of luck involved if you were able to do that. And I'm by no means I'm not hating. Like, congratulations if you made those returns. Like that's really cool that you were able to do that. But and then a lot of the people that talk about real estate, how many of them? We had Andrew Bang on the podcast, who is a client of ours, owns a bunch of real estate, and he was talking about Robert Kiyosaki, who's the Rich Dad Poor Dad author, and he talks a lot about real estate. And he made the point, it's like, if you, like just the nature of how you scale that real estate investment, like by putting in a down payment originally, that cash flows until you can take equity out of the home and put that on another down payment. Like you can just run the numbers on that, on how slow that would get you to like 200 properties or something where you're making like 200 grand a month in real estate.
Sure.
So like just by that math, Andrew Bang was talking about how like Robert Kiyosaki didn't make the bulk of his money on real estate investments. He made a bulk of his money talking about real estate and selling books about real estate and Rich Dad, Poor Dad and all that stuff. So how many of these real estate people that showed that they're multimillionaires in 3 years, how many of those people sell courses about real estate and make a bunch of money that way? Like it's not this end all be all investment where anybody can throw money at a property and then that's completely, you can replicate that 50 times over, leverage 20 to 1, and you'll be a millionaire very quickly. Because if there was an investment like that, then, I mean, basic economics would tell you that all of the capital would flow into that investment, and then the excess returns would go to zero. So, like, that wouldn't exist in a free market. And then you can argue that cheap money and all the stuff that happened during COVID, that was that allowed some of these excess returns. But if you were gonna do that today, I mean, we could talk about why right now wouldn't be the best time to buy real estate in general because of mortgage rates and everything else. But yeah, that's basically the point that I wanted to hit home was when people say real estate investing in rental income is passive income, it's an insane claim because it's basically a full-time job to manage properties. You have one property, and I'm sure it's a big enough headache for you. Imagine doing that for 20 buildings. And however many tenants.
Yeah, I mean, that building has, I think, we've got about 9 tenants in that building right now. And most of them are, they have those small offices, and the only time I hear from them is when they drop off the rent payment. But occasionally you're going to get them who call, hey, the toilet's running, hey, the sink is clogged, all that kind of stuff. So, it's something you either decide to deal with it yourself or you hire somebody else to do that. If you hire somebody else to do that, that's going to cut into your, the profit, obviously, that you make on the building or your ability to cash flow that building. But in my case, I do hire a lot of that out because I have to keep in mind my number one job is Crosby Advisory. Yeah. My number one job is taking care of our clients. It's not the building. The building allows me to be there. We've got tenants in it. That's great. I have said before that something that might shock people is that I believe that most investors who are long-term investors probably own too much stock exposure in their account. And that's why, not because the stocks aren't a great investment, they are a great investment, but the investor that, we go through the downturn like 2022 and they panic and they're selling out of everything at inopportune times and taking those losses, that would tell me that their portfolio is not allocated in a way that they can ride those, right? We're tactical in what we do, but there's a difference between being tactical and panic selling. Mm-hmm. And so for those who suffer from the panic selling, well, that's an obvious sign that you own too much stocks, too much of your account is stocks and probably growth stocks. I think there's also a danger in owning too much real estate. I bought that building, and what's funny is I told myself I owned another commercial property prior to this, and I told myself I was never going to own another commercial property again because my experience was bad. We had a business in there. The business moved. It was a property that was going through the downturn, and we had a 2008 housing market crash, right, that happened, and real estate was bad for a period of years. I couldn't unload it. So I went years paying on a mortgage that had no tenant in it, nobody living in it. And the funny thing is, if you've got a building with no tenant in it or nobody living in it, the insurance company now charges you triple because you've got a vacant property. A vacant property is more expensive to insure because there's nobody in the house to, if something's smoking or if a pipe breaks, there's nobody in the house to see that. So the claims tend to be much larger, right? And so that's what I would warn about somebody. You see those Instagram ads of these people who are overnight millionaires by buying real estate, which is a farce. But what they don't consider is when things go bad, it's not a liquid investment. I just can't snap my fingers and say I'm out of this property. I mean, real estate has created many wealthy people over the years as long-term investments, not short-term investments. But it's also bankrupted a lot of people, right? How many people have done that that strategy you were talking about that we would advise against, where you're taking a mortgage out against your home and you buy a rental property. If that rental property goes goes belly up, or your house goes belly up, I mean, now you've created danger for
bankrupt.
Yeah, you're done. You're done. Yep. So so many people fall into the trap of the get rich quick, right? Mm-hmm. And so because of that, they take on unnecessary risk. You have to avoid that. You have to realize that true wealth accumulation, in the sense that I'm going to accumulate it and I'm going to maintain it and I'm going to keep it, is a process. It's not a gamble. It's not a roll of the dice.
The one thing I will say to come in defense of the Instagram real estate people is they do make a couple good points. I mean, it's hard to lump them all in the same group, but as far as like my experience in following some of them or whatever, they make a good point that cash flow is important with investing, just like we talked about with value investing, dividends, cash flowing companies, stuff like that. If you can, and then also the same point of value investing where just because it's a property in San Francisco that's worth $1 million, that doesn't mean if you pay $1 million that property is worth $1 million, because those are set by the market basically. And what we're seeing now is once rates get jacked up to oblivion, and then your point about it being an illiquid investment, it's like you're the one stuck holding the bag. These prices get bid up in 2020, 2021 by whoever it is, these very liquid investors that come in and give 100% cash offers, things like this. And then once the tides turn, the retail investor is usually the one that gets stuck holding the bag, and then you're stuck with $1 million property that in reality was probably only worth $1 million for about a week, and the intrinsic value of the property might be closer to like $500,000. And I'm pulling these numbers from nowhere. So there is, if you're investing in real estate, keep the value investing mindset where, what do the properties around me, what are they able to charge for rent, and use these types of valuation metrics and keep your head on straight, and don't get, I forget what Dave Ramsey calls it, but he has a name for it where like house fever, essentially, where you get in this mindset where you're like, I'm going to buy a house, and then you put blinders on, and then you're just looking to buy a house and you throw valuation out the window. And that comes with buying a personal residence as well, when it's like you have to take into consideration, just like buying stocks, it's like you want to buy it at a value. You want to do Warren Buffett style investing, and then that at least sets you up for success rather than just getting caught in the fever, getting caught in the get rich quick mindset, and then that's what's going to wipe you out, because you're more likely to lever up more than you can afford, and all these other different pitfalls that a lot of investors fall into in general, not just real estate investors. Yeah, absolutely right. So in a perfect world, I bought my building, and it cash flows. I've got enough tenants in there that it's paying the mortgage most months, and the expenses most months. And so if I held that for 20 years, I've got a building that somebody else paid for. Yes, I put a deposit down onto that, but the bulk of the building somebody else paid for. And then I have a building to sell at one point in time. And then along the way, I depreciated the building, so it helped me with my taxes. Mm-hmm. I have go ahead, sorry. That's in a perfect world, right? But there are going to be months that are not going to cash flow. There are going to be years where I have less tenants in the building. The other thing that I think you have to do is, Derek, if we were going to buy the S&P 500 index and we were going to hold it for the next 30 years, I would be prepared to see that index cut in half at some point in time, mm-hmm. right? Or more. Mm-hmm. If I look at 2008, the index from peak to trough fell just a hair over 50%. So I think when you buy a real estate, whether it's a commercial or residential or whatever you're doing, I think you also have to be prepared for the large loss. Mm-hmm. The roof needs repaired. A tornado came through. And you could say, yes, maybe the tornado is bad because you'd have an insurance claim there. But something that would happen that is going to happen, your boiler is going to need replaced. Something that's going to have a large expense to that. So you can look at the cash flow and say, yeah, look, it meets the mortgage,
but you're going to have expenses above that. And so you have to figure that into consideration. I want to say one last thing, that to me this was genius. If you are going to get into real estate and you're going to have tenants, a friend of mine named Keith Denman owns Denman Construction out of Cortland, Ohio. And if you ever need anything done, he's the master. He designed my deck for me. And it's beautiful. Helped me with ideas for my kitchen. But he is somebody who is very keen on that, right? And he said, Nate, when you have a piece of real estate, you have an asset and you have a liability. What is the asset? And I said, well, the building's the asset. And he goes, no, it's not. He goes, does the building pay the rent? The tenants are the asset. So when you think about that, if you truly are looking to be long-term and you're gonna have real estate that you rent out, you got to figure out a way to take care of those tenants. You would protect those tenants and you would care for those tenants just as much as you would care for the roof, the pipes, all that kind of stuff, right? Even more, obviously, because you want to care for those tenants, you're going to want to make sure that the building's in nice working condition. But I think it's important to remember you're making that money not off the building. You're making the money off the tenants that are in that building.
Yeah, for sure. Yeah, I think that's really good insight.
So yeah, shout out to Keith. That was awesome.
I have a philosophical experiment for you, okay? So if you replace the boiler in a building, is it still the same building?
No.
Oh, you're saying no? Okay, then it blows up the philosophical. The I forget who thought of like the paradox, but it's like a ship is made out of 100 planks of wood. If you replace one of the planks of wood, is it still the same ship? Everybody usually goes, yes, it is the same ship. And then you go, well, what if every single piece of wood is replaced? Is it still the same ship? And then it's kind of like a paradox, but you blew it up because you think differently.
Yeah, well, I think differently because I'm thinking if I'm going to buy it, right? If I'm going to buy a building that just had a new boiler replaced, it's actually more valuable to me than one that's got a 30-year-old boiler in it.
Sure. Yeah.
Let me ask you this.
Okay.
You've got a 65-year-old who's got clogged arteries and he's days away from having a heart attack. Is he the same 65-year-old as somebody who just had a heart transplant and has another 5 years ahead of him probably of clean living? It's not the same body, even though you've only replaced one organ. Right.
Yeah, that makes sense. That's it. I think I wish I knew the philosopher that pondered on this, because you would blow up his entire argument. So that's pretty funny.
Let's talk about the Fed's fund rate here for a second.
Okay, cool.
This is interesting to me, and we're not going to get political, but we have to poke some fun at some stuff here.
Of course.
So Jerome Powell came out the other day, and he said the terminal funds rate is probably going to go higher than we originally expected. Mm-hmm. And somebody says, well, what's the terminal funds rate? The terminal funds rate is that long-term target rate that they expect to achieve. So the
for this hiking cycle.
Yep, for this hiking cycle. And they're saying it's probably going to be higher than we expected. Well, why would that be? Well, the economy is way more resilient than we expected it to be at this point in time. And because of that, it appears that the rate of deflation, the rate at which inflation is coming down, is slowing a bit. And so we're going to find that out. We've got a new number coming out here shortly, Derek, probably in about 5 days or so?
Yeah, next week.
So with that, the markets saw that as not good news. Obviously, if rates are going to go higher than we expected, then if I'm a growth company, that's not good news for me. The cost of business just got more expensive. But I think there are some things as investments that are falling into our lap that we can kind of get into if we want to, that are positive to those rates going up. But here is the disconnect. There is a Senate committee on banking that meets, and it's their opportunity to ask Jerome Powell some questions, what they're doing. I don't know about you, Derek. I find that it's more about the senators standing on a stump and maybe campaigning for their own behalf, listening to themselves talk, than actually asking Jerome Powell questions that are. And to my point, so Senator Warren, who asked Jerome Powell some tough questions. You could say there were some tough questions. You could argue whether they were intelligent questions or not. So so she asked Jerome Powell directly. He said, we're going to have to raise interest rates. That terminal rate is probably going to go higher than we expected. And her question to him was, what would you say directly to the 2 million plus people who are likely to lose their jobs because you're raising those interest rates? And his response, Derek, you probably heard it, was, unfortunately, unemployment, the rise in unemployment is it's an undesired consequence of raising interest rates. He said, our only tool that we have to bring inflation down is to raise interest rates, right? We have to kill demand. And by killing demand, the collateral damage to that is going to be people losing their jobs. So she's grilling him as if that's his only option. Like he's doing this like because he wants to do it, right?
Yeah, right.
Not because, and his response was, well, what's the alternative? Do we keep inflation at 6.4%? How many millions of people does that hurt?
Yeah.
Because the last month the CPI came out and it was at 6.4. But in March of the previous year, it was at 8. So it's 6.4 on top of 8, on top of what it was before, right? How many people have seen that level of increase in their pay? How many people over the past 2 years have seen that level of increase in their investments returns?
Or just growth in the economy in general.
Exactly.
Like imagine compounding GDP at 8%. Like, I mean, we'd have flying cars in 10 years. Like it would be insane. That's an incredible growth rate.
Yeah. So that's why I say when I look at this, I mean, Senator Warren, I know that she's an intelligent lady. She went to a nice school. But you're not pulling the wool over her eyes as far as what you're doing there. I can't believe that she thinks that, doesn't see the whole scope of this, why they're having to do this. Mm-hmm. If there's a critique about Jerome Powell, I don't think it's the fact that people are going to lose their job because interest rates are going to go up. I would say, why were we at zero? And I know this is a problem that he's trying to solve. Why were we at a zero interest rate essentially when the economy was doing the S&P 500 was doing double-digit returns and the economy was strong? Mm-hmm. That would be my critique.
Here's if I'm in Jerome Powell's position, I would be, so why is Congress running these massive budget deficits which are inherently inflationary? It's like sure. It's like, what do you guys, okay, hook me up, help me out with inflation a little bit. Like they're aggressively spending into the economy, like which is inherently inflationary.
Can I stop you right there?
Yeah, go ahead.
Because I think that's a great point, because you can say a lot of things about Jerome Powell. And you and I, a couple of years ago, he was the butt of our jokes when we were talking about transitory inflation, right? We both said that's ridiculous. And the fact that nobody saw inflation coming. A lot of people saw inflation coming. Mm-hmm. But the one thing I will say about Jerome Powell is he is a professional. What I mean by that is he takes on questions like that, which are designed to be a lot of pomp and show with not a lot of substance behind it. Mm-hmm. But he is doing his job. He's trying to do a difficult job. We had said before on the previous podcast, the Federal Reserve is between a rock and another rock. It has a nearly impossible job of bringing inflation under control with a very resilient economy without wrecking that economy, without taking it into a deep recession.
Finish your point.
My point is, you have never come home. So Joe Biden is on record. He's proposing that the pay increase for the federal employees go up 5.2%, which would be the highest increase in the past 43 years. So to your point, Derek, you've got the Federal Reserve on one hand, who is trying to bring inflation under control. And you've got the federal government, which is in a spending, it's been spending like crazy for years and years and years, right? Mm-hmm. And it's not slowing that down. It's accelerating. It's looking for things to actually increase that spending on.
Yeah, I mean, we're going to go into the debt ceiling debate here in a couple months.
Yes. So working counter, they're essentially playing tug of war, right? So every time he raises those interest rates to kill demand, we've got our federal government who's looking to spend more stuff.
I thought it was funny. My first thought when she grilled him on, I think it was 4.6% inflation, I was like, just wait until Powell and the FOMC come out with their summary of economic projections in next week. I'm like 4.6%. I'm like that could be a whole lot higher. Like I forget which other senator it was, but he was basically like back testing, or I don't know. He probably wasn't doing any of this research, but basically, historically speaking, what inflation would have to get to bring this high of inflation down. And he said that number would probably have to get closer to like 10% unemployment. Don't know if it's going to get that high, but 4.6% inflation is still, I mean, when you look at the Federal Reserve's dual mandate, it is to achieve full employment, which is generally considered around 3 to 5%. So 4.6% unemployment. I mean, yeah, you could give him an unfair question and say, "Oh, all these people are going to go out of work." It's like, well, you're not going to have everybody working at every single instance in the economy at every given point in time. It's 4.6% unemployment with 2% inflation. Again, we can argue 2% inflation, is that a good goal? I don't personally think that's a good goal. I don't think inflation is not something that's like embedded into the economy that has to happen. That's just but we have to exist in the paradigm that we're in. But sure. 3 to 5% unemployment with 2% inflation is much better than what could happen in this hiking cycle, and a much more desirable outcome than what's probably going to happen in the second half of this year and next year if we get a recession, which is probably the most likely outcome.
Yeah. When you hear her statements, it's almost like they live in this Pollyanna world where there's no consequence, right? And part of that is because the world that they live in has no consequence. And what I mean by that is there's no budget that they stick to. They blow through the budget. They print money when they need to. So the fact that there is going to be some pain involved in bringing this inflation down, and her pretending like you can either ignore it, like it's not there, or somehow achieve this without anybody, unfortunately, losing their job. I think it's. I don't actually believe that she believes that. I think she's just saying that. Yeah. Yeah,
I agreed. So, and then I believe her background is law. I believe. I don't know if I think she went to Harvard. I don't know that much about her background in the private sector, if she has a background in the private sector. I don't know if she has experience in finance or banking or anything like that. But if I were Jerome Powell, I'd be like, I'm open to suggestions on how you believe that we can bring inflation down to previous levels, pre-COVID trend, without any effect on unemployment. Like I'd be very open to suggestions from anybody, especially if you're the one critiquing my performance. And I generally agree with you. I think Jerome Powell is doing a good job, in quotation marks, I guess, because they screwed themselves so bad with the monetary policy in COVID and all the money printing that it's basically you're in between a rock and you're not going to get out of this unscathed. This whole like no landing narrative, I think that's completely incorrect. So I think he's doing what he can do, and I don't think anybody else would be able to do the job better than what he's doing right now. He's just operating with the tools that he has. Not giving him a pass because he obviously screwed up during COVID, but at this point in time, I think he's doing the only thing that he can do.
Yeah, let's be clear that he is the federal chairman, but there are other members, right? And so I think he's actually doing a very good job as a professional. You know, what he's trying to do is not an exact science. What he's trying to do is, in many ways, trial and error, and hoping not to have too much of the error on that. You know, he's telling you, he hasn't changed his tone from the very start of when they started raising interest rates. We are going to get this until we reach our target of 2%, right? And the media spins it. You know, senators like Warren will come out and say stuff to try to get him to change on that. And
Wall Street. Wall Street does too.
Wall Street, yes. Yeah. He's been very steadfast. So there's no mixed message that he's sending out. I mean, he's telling you what's going to happen, right? Mm-hmm. Whether you, as an investor, want to accept that or not is a different story. You know, an analogy that I would use, I took a self-defense class one time. We did a lunch and learn at our office, and we had a husband and wife team who taught self-defense come in. And one of the things they taught you said you're not going to get out of this unscathed, right? So one of the techniques they taught was somebody comes at you with a knife and they're stabbing you. You're likely not going to get out of that unscathed. Like I know there's great movie scenes where you're going to take that knife from them and nobody's cut or you turn around. So they would do techniques like they're coming at you with a stabbing motion, and you offer your forearm to block that knife, right? Because the forearm is a bone. Hopefully, you're not exposing it to any arteries that are going to be cut and cause problems. But if you could take that into your forearm, and at that point in time, either allow yourself to run because you've blocked it, or take the knife from them, or whatever that might be, that is probably a better technique and probably has a greater chance of you getting out with your life than attempting to avoid the knife altogether and it lands in your gut or your wherever, right? So I think that's where we're at, and I think he realizes that too. There unfortunately is going to be some pain with this. Hopefully it's not too much pain, and hopefully he's successful. And I'm rooting for him because actually, our clients and you and I are part of the process. Yeah,
and then the benefit of the rate hikes is that, I think this is the last thing you want to talk about, is the fixed income investing that we're able to do right now. You're able to park money in again, risk-free in quotation marks. There's no such thing as a risk-free investment, but a 3-month treasury bill is probably about as close as you can get. And you can park money there, roll those over, collect the coupons at around 5%, and those are going to get higher as these rate increases are going to play out. Probably, we'll probably see the Fed funds rate around 6%. I think consensus was sub 5. Now it's 5. Now it's like 5, between 5.5, and I think we'll probably see 6% plus. But I mean, if you don't have to be invested right now, if you don't have to have a 100% allocation, if you're not a blindly dollar cost average into the S&P, which is a profitable strategy long term, but if you're not that guy, then you can just you can just sit on the sidelines, collect these coupons, and wait till a lot of this stuff plays out. I think unless you have a contrarian view at this point that says we are going to have some no landing scenario and we're going to get out of this completely unscathed. I mean, what I'm doing with my personal investments is just stockpiling cash and then finding these risk adjusted returns in these treasury bills, in these money markets. I don't think that you have to take on excess risk when you're not going to be rewarded for it. It's kind of my thought process. And then on the other side of this, you're going to have a mountain of cash. Yeah, I mean, your money market's going to pay 4.5% roughly. I was looking at the 3-month T-bills earlier this morning. They're over 5% right now, just a hair over 5%. There's not a lot of reason to go in duration much beyond 6 months because the return on that is essentially equal. Once we get into the 9 months. So, yeah, I mean, if you can roll over a 3-month T-bill at 5% or a 6-month at 5.5%, and likely rolling it into something that is going to pay a higher interest rate in 3 or 6 months from now, that's not a bad deal. Yeah, I mean that's I mentioned what I'm doing with my personal investments, and then what also we're doing in our strategies is something similar where we're loading up on these 3-month treasuries, and then there's going to be maybe some curveballs when the debt ceiling debate comes around sometime later in this year. But I think if you were going to allocate for the probability that they were going to default on the debt this year, I think you'd probably be doing yourself a disservice. I think that has an extremely low probability. Not zero, I guess, but I think that's an extremely low probability. I don't think the incentives are there for them to act on that. Yeah, let's hope not. All right, Derek, anything else to add before we head off into the night? As always, thanks everybody for listening to the podcast. If you liked it, like, share, subscribe. Wherever you get your podcasts, follow us on Facebook, Instagram, LinkedIn, YouTube at Crosby Advisory. Subscribe to the newsletter by going to crosbyadvisory.com/contact. And we will see you guys next week. Keep in mind that Crosby Advisory is a registered investment advisor in the state of Ohio, Texas, and Florida. And at any time, you can request our forms ADV 2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today on the show, Derek and I mentioned specific securities and investments, and that is not a recommendation for you to go out and buy them or sell them. Please do your own homework and make sure they are suitable for you. Keep in mind, investing is a process that involves risk, including the potential loss of principal, and you should carefully consider all risks and fees before making an investment.